I always tell these kids, and I'm sure you do the same, I go, I don't need a computer to analyze a real estate deal. If I can't do it on the back of an envelope, it's not a deal. I mean, there's a lot of simplicity to real estate.
Hey, Ray, thanks for joining me today. Looking forward to having a conversation with somebody I've known for, let's add it up, 40 some odd years.
Oh, yeah, mid-40s. So, yeah.
It's a long time. So thanks for joining us today. Looking forward to having a great conversation.
Or better, Terry, we've known each other long enough to be through about 4 really bad economic cycles. So about
Exactly.
that. Yeah.
Exactly. We're both still standing. So
Yeah,
good for both of us. So, Ray, I want to start by having you tell our folks about your background and how you got here. Because I know a lot about your background, how you got to where you are today.
Yeah, sure. I'll be quick, but I grew up in Dallas, went to Highland Park High School, went up the street to SMU. And, I like to tell people I was infected with the spirit of Dallas because going to school in the late 70s, early 80s, that's when Dallas was booming. Oil was off the charts. The TV show Dallas was the number one show on television. Real estate was booming. The SNLs were just starting to really pump money into the economy. And it was crazy. People just getting out of college or really in college were making incredible money and driving around, 450 SL Mercedes and spending money like crazy. So it really was a very enthusiastic time to be in Dallas. But my father was in the banking business and their bank was having some issues. So I was the 5th of 6 kids. And I was given a choice. Either my sister could go to college or I could go to college, and they would pay for one of them. And so my little sister went to Sewanee and I went to SMU, which is not cheap. And so I had to figure out a way to pay for it. So I got my real estate license when I was a freshman at SMU, went to work for a guy named Don Tobin, who was a shopping center developer in Dallas back in the late 70s. But I wasn't making any money. And so to be able to pay for school, I started a carpet business there. I did carpet installation into the freshman dorms and a lot of the apartments around SMU. And really, I was able to pay from SMU being a door-to-door carpet salesman. And then I got the vending machine contract in a number of apartment complexes like University Gardens and other ones close by. And that was my spending money during the week. And then I'd get up every morning and go work. And then I went to work for the Joe Foster Company, which is a pretty good sized brokerage shop in the early 80s, and worked there. And then when I got out of college, I went to, had an opportunity to buy some rent houses and fix stuff up and just kind of the traditional way of rolling along. But really, I'm infected with the spirit of growing up in Texas and Dallas. I mean, SMU, I was in Eric Dickerson's class and we're, winning all the football games. My high school was winning state championships. So, I mean, I just really, everything I was around were winners. And so you got up every morning because you want to be part of that whole ecosystem.
That's fun. And obviously the entrepreneurial spirit that Dallas is all about. You and I have both been infected with that bug for a long time.
Sure. And, Terry, first time I think I met you, to brag on you a little bit, I think you were at Huff Browse, but I think you were starting to do build-a-suit Blockbuster stores. And I think you were doing them in Memphis. And I'll never forget, I think we sat down one day, you were looking for money, not realizing I didn't have any money, but raising money from people. And so, I mean, you were cut from the same cloth. It was like, find something new. Blockbuster's a new thing. And I always remember that time you gave me the pitch and I was like, okay, this is kind of interesting.
Yeah. And neither of us believed that we couldn't do anything, So
that's right.
That's pretty fun. Thanks for reminding me of that. Hey, you've been successful across multiple sectors, investment types, from charter holdings to M-Crowd to Highland Park Village to your time with the first Trump administration, running OPIC, and recently forming Gillen Property Group. Share some of your core principles, lessons learned that have guided your investment and leadership philosophy.
Well, one is first integrity, because in Dallas, even though it's a large city, it's actually a small town. And if you one time try to screw somebody around or mess with a contract or a closure or something like that, your reputation can be sullied very, very quickly, and you're pretty much out of business in this town, even though it's a huge city. So very early on, especially for your younger listeners on this show, is it takes you a lifetime to build a reputation. It just takes one bad deal, one bad Really, a bad deal isn't the problem. It's the way you handle it and the transparency you have. So I think very early on, I learned about transparency and integrity and building a reputation that people want to know they can depend on you, and a handshake is a handshake. Now, there are other markets like maybe New York, or that isn't as important. It's really, they're transactional per deal. Here, it's really a body of work over a lifetime that builds that. And so reflecting back on all the time you and I have known each other, it's really, we can look back. I bought properties from you before. I've been a tenant of yours before, and it just comes down to people looking you in the eye, knowing you're going to do what you say you're going to do, and having that kind of reputation. So I'd say that was the biggest thing. And, when you go to Washington, I served for 4 years administration. Before that, I was the national finance chairman for the Republican Party. So I've traveled the country extensively. And in DC, you find out Washington is a very transactional town. Transactional town. People you meet aren't going to be in the same job 60 days from them or 90 days from them. So it's a real revolving door of relationships. But up there, I've learned now that I've been real deep up there for probably the last 25 years. Like, I'm going up there actually tomorrow morning for a couple of days, and I'll end up running into a lot of people I know. And it's the same thing as I'll say in reputation here. If you have a good reputation, people will want to continue to do things with you. You just got to realize the average. I always told people that came to work for me, you have an expiration date on your back the day you start. No one ever in business would tell you that. You would never hire anybody to work a trademark if you said, you know what, 6 months from now, you probably won't even be here. Or the average time for somebody at trademark might be, in the federal government, it's 17 months with presidential appointee. And so with that coming in, I would always tell the people I'd hire, it's like, it's how you leave this place. It's going to get you your next job. And as people look back and talk about you in the future. So that's another case of reputation is everything. In Washington, it was just amazed me at how quickly people hopped up. The day they take a job is the day they start looking for the next job. And I always tell people, that the longer your title, the less power you have. So the number one title I have is president. Number 2, vice president. And then 3 is secretary of state or secretary of treasury. So the longer the title, the less power you have. So you meet some people that are deputy secretary of this for the Northern Hemisphere or that, and these cards are just unbelievably long. You realize that guy didn't have much stroke. So it's going to.
That's great. So you were the chairman. What were you of OPIC?
I was a chairman and CEO of the Overseas Private Investment Corp, which was really
That's a lot of words. That's a lot of words there, Ray.
No, I sort of chairman.
Okay.
Chairman. I had an CEO. That's pretty short. But the title of the agency was very, very long. It's a little history on it. It's really the vestige of the old Marshall Plan from World War II, when the United States went in, helped European countries and Japan kind of get lifted back up with what happened to in World War II by financing U.S. companies to go in these countries and doing projects. Since it's evolved, we did business in 180 countries around the world. And if you wanted to go build a hydroelectric plant in a third world country like Botswana, but no one would lend you the money, but it was a legitimate business deal, we could give lease guarantees, insurance to protect you from, governmental interference in those countries, things like that. So it was a fascinating job when we managed a almost $60 billion portfolio around the world.
That's great. I'm going to shift to something you and I are both into, operating high-end mixed-use places and retail places, which is a different challenge, as you've learned the last several years, than other real estate. How has that experience shaped the way you think about creating long-term value now?
Well, over my career, I've been involved in every property type, from industrial to hotels to apartments to townhouses, a lot of grocery anchored retail in the suburbs to strip centers on the inner city. And when we bought the Highland Park Village 16 years ago, it really was the dog that caught the car, because there are very few luxury shopping centers in the country. And you can probably count on less than 10 of any substance or size, because I like to say I operate in a dictatorship, not a democracy. A democracy is Worth Avenue in Palm Beach, that's multiple ownership. Rodeo Drive in Beverly Hills is like that. Worth Avenue in Palm Beach that way. In Dallas, Snyder Plaza is that way. You have 50 or 60 owners of property. So what I quickly learned was no one really in the country controlled luxury retail where they own basically every store and you can merchandise the center to where you don't have the tattoo. You don't have to worry about the tattoo parlor going in next door. You can be sure you don't get chain of restaurants in there that dilute the brand. So I would say that the first lesson learned was that, and the fact you really have to invest in owning a luxury center really needs to be owned by long-term, really a family versus a public entity. And the reason I say that is if you look at luxury retail around the country, ourselves at the Highland Park Village, Shops at Bal Harbor in Miami, Americana Manhasset in Long Island, South Coast Plaza in California, all owned by families. Why is that important? We're not looking for quarterly results. And so I like to tell people, even though we've owned the village 10 years, it took me 10 years to become an overnight success. We bought it. The average rent was $36. The infrastructure is in horrible shape. So we had to come in, and people that have been on site, you've seen, we bricked the parking lots. We've added trees, fountains, flowers. People always say, well, I can't believe you spent millions of dollars on brick. How can you really quantify a return? I said, you can't. What it is, it's about a lifting tide. I mean, a lifting tide that lifts all boats. Well, by doing that, it encourages people to want to come shop here, the flowers and things like that. So it's really, you can't say, oh, I put in brick parking lots and I saw sales increase 20% because that went along with planting mature trees, not little, like I was just at Snyder Plaza. They did not brick the parking lot. They put little tiny stick trees that are going to take 50 years to grow. Here we've got big mature trees. So things like that is one thing I learned. Since then, we're taking that experience to Kansas City. I bought Country Club Plaza a year and a half ago. To 16 city blocks, 1 million square feet that had really been owned by 2 public REITs. And for the last 5 or 6 years, they'd put no money back into it. And the way a public REIT works, they got to show quarterly returns to their investors. So they were not pumping stuff in the brick streets and fountains and flowers. They needed the Wall Street analysts wanted to see credit on their rent growth. So they went with people like a PF Chang or a Chewy's or these chains that people are like, well, we have those in every market in the country. Why do we want that? They don't have the local F&B scene like in Highland Park Village. We have Cafe Pacific and Mi Casina and Bistro 31 and a lot of where people want to drive from Shreveport or from Fort Worth to Dallas to come try out. And so we're in the process of a turnover, but Kansas City is the same thing. That's going to take me about probably 5 to 8 years to become an overnight success up there as well. But we've explained it to the people in Kansas City. It's like, you don't want us to put lipstick and do this cheap. You want us to do it right, and it's going to take time to do that.
Yeah. So regarding Highland Park Village, tell everybody the story. Because I was in and around it and when watching that happen, and tell everybody the story of you and Stephen getting involved there and how y'all the approach you've taken and how you've been able to optimize that opportunity.
Well, first, I think you were probably one of the people who said I paid too much when I bought it.
me and everybody else, right?
Everybody else said I paid too much. Well, I had operated Mi Casina restaurant here for 20 years previous to buying it. And I grew up down the street, so I spent my childhood coming here. I also went to school down the street for 4 years, in which case, not one time when I was at SMU did I come to a mile east or a mile west and step foot in the Highland Park Village. And I bet you didn't either, other than the only reason the girls came here was they had a store called Harold's where they'd buy their preppy clothes. Other than that, no one came here. So it was really, I knew it as just a sleepy center. But I knew operating a business here for 20 years, it was tired. The rents were way too low, shockingly. I mean, I was one of those tenants that got those very, very low rents because the landlord wasn't investing back into the center, so they couldn't justify charging you more. So one night in December of 2008, my wife and I came up here to see the Christmas tree lights were on at Mi Casina. And we had very young children at the time, so we never really left. But I said, the lights had just come on. I said, let's go see how Mi Casina is looking. And I was having dinner and one of my waiters came over and they called me El Jefe because, boss. So they come over, they go, El Jefe, this table, gentlemen over here, about 2 tables over, are talking about buying the Highland Park Village. I was like, there's no way. That'd be like Jerry Jones putting a for sale sign Dallas Cowboys, it just would never happen. And the Miller family had bought the village in 1976 for $5 million. And so there's just no way they're selling it. They had a lot of family members involved. So just then, and I believe God's hand is in everything, Henry Miller himself comes walking by the table, just as the waiter walked away. And he came by the table and said, Henry, he was getting a to-go package. He said, hello. We talked about the lights. I said, listen, I hear you're selling the village. He just turned white as a sheet. He goes, what are you talking about? I said, well, I just kind of heard that. He goes, I can't say anything. Call me tomorrow at 5:00, and turn around and walked out the door. I was like, all night long, I spent thinking about it. The next day at 5:00, I called him. He said, how quick can you get over to my office? And, the wheels were screeching, and I got over there as quick as I could and sat down. It had been under contract. Now, people forget this is when the great financial crisis was happening. This is in December. I don't remember the exact time. Lehman Brothers had gone down. Bear Stearns were going bankrupt or had gone bankrupt. Everybody was terrified. This is all, the world was ending.
The Lehman crash was September 2008, and you were 4 months later.
So 4 months later. And so the family wanted to get out. They had 18 family members kind of eating out of the till here. So some tenants were, having lots of trouble. Retail sales were really bad, a really bad Christmas. So I went in and I always tell these kids, and I'm sure you do the same. I go, I don't need a computer analyzed real estate deal. If I can't do it on the back of an envelope, it's not a deal. I mean, there's a lot of simplicity to real estate. And I just sat across the desk from him. I worked out a deal on an envelope that value stood up, shook his hand, and walked out the door. And we had a deal. And so I got under contract in January. About 2 weeks later, I mean, I was afraid word would get out. It was for sale and some other people would pop in. So I kept totally quiet, which is tough for me to do. And got 2 weeks later, got under contract, went all the way till April. Was coming home from the Rangers opening game in Arlington with a car full of kids. Got a call from HFF, my mortgage, and the company, the bank in Germany that was going to do the loan for us backed out. And I was hard with $1 million, I think, or maybe $2 million. I had to find a lender to come in, and I ended up putting a deal together. I got the family to take back a first loan. I got Harlan Crow to lend me a second, and I put in equity on top of that. So no bank was loaning money for anything, as you know, in the spring of 2009. And the only way I could do it is the family had a lot of equity in it, and they really wanted to get it sold. So first thing we did, like I said earlier, is a dog that caught the car. We closed it May 20th of 2008. And then we got on a plane, my wife, my brother-in-law, my sister-in-law, we flew to New York and just started going around the Chanel and our tenants saying, what do you think? What do y'all want to do? They're all like, well, the center's in horrible shape. We might all go to North Park. And so I knew immediately we had to put money back in the infrastructure. So we started doing that. And then we started visiting, again, global financial crisis. Banana Republic was the largest tenant other than Polo, believe it or not. They had 10,000 feet.
Yeah, in the back.
Between Honor Bar today and the theater.
Yep.
And sat down with them. They were paying $32 a foot. And they said, we'll stay if you cut it to $25 a foot. And I go, this isn't the way this is going to go. We turned around, cut the spaces into 5 different tenants, which are there today, like Love Shack Fancy and others. And we started leasing space for $75 a foot and then $85 a foot. Today, my average rent when I bought the center was $36. The last lease we did was $600. And so that's our quoted rate. Now we're probably going to go to $650 later this year. The reappealing, we're crazy. I can't believe we can achieve that. But the gross sales in the village have gone from $82 million a year. This year, they were close to $700 million. I think we'll push to $1 billion in the next 3 or 4 years with pretty much the same square footage. But we've replaced tenants that were like Reptile Tie Shop doing $800,000 a year with a Rolex store doing, 30 plus million. I mean, it's the same square footage. We're getting a lot more productivity out.
Yeah.
And
y'all have done a great job, and it's been fun and amazing to watch and be a little bit of an insider, getting to hang out with you from time to time. So
yeah. Well, the
done.
interesting thing about it, people think it was here. Someone just had, it was like when Michelangelo carved the David. They asked him one time, he go, well, how did you do that? He goes, well, it was a huge piece of marble. He said, well, he's inside of there. I just had to get him out. And so when he carved it, and the same with the village. If you look at the demographics of Dallas, when I got out of SMU, you and I got out, it's probably 1.5 million people in Dallas-Fort Worth. Over 8 million today. And so just from the sheer number of people in this city, having a unique shopping experience where you feel safe and unique and it's clean and it's a fun place to hang around,
Yeah.
is what we're trying to achieve.
Well, you talked about doing a lot in Dallas and knowing Dallas and being heavily invested in Dallas in multiple sectors. Share your view of the future of DFW and Dallas in particular and its future potential for real estate investments.
Well, I mean, the Chamber of Commerce answer to that always is greatest airport. DFW, I think, has more nonstops internationally than any airport in the world now. Left field, not many cities have two massive airports very close to each other that you can use. So central time zone, all those things. But really, it's having good government, clean government to where you can go down. It's frustrating for everyone to get building permits and things like that. That's because of the volume of work being done. But there's not a bunch of hanky-panky going on like in Chicago or a lot of other markets. I mean, you can get things done here. And it's a very transparent business community. As I was saying earlier, people know who you're dealing with. So someone calling in that do business, it's everyone's 1 degree of separation to finding out if somebody's legit or not. And so I think that says a lot for this market. Other markets, you don't know who you're dealing with in a lot of cases.
Yeah.
Now, as far as Dallas going forward, we do have issues. The city of Dallas in our downtown area. Dallas is the city of Dallas, not the metropolitan area, just the city of Dallas is really a series of spectacular neighborhoods, everywhere from Lake Highlands, Lakewood, Kessler Park, and Oak Cliff to M Streets, the Park Cities, Crescent Hollow. I mean, there are a lot of great neighborhoods, all supported by property tax. And the core of downtown, which has been our primarily property tax payer since the beginning of time, is losing value on a daily basis. So the ability to tax a building like the Bank of America Tower, which today it's 2 million square feet. If you replace that building today, it'd be $1 billion building. Well, today it's probably going to sell for $50 million. I mean, it's a joke. So you put the taxing value on that. So, but you go north of Ross Avenue into Uptown, it's as booming of an area as anywhere in the United States, values and everything else. But our core downtown is rotting. We don't have any visionary leadership at the city to work through, which it's going to end up being a mess if we lose AT&T. It's just going to be a huge downtown residential neighborhood. It could become another great Dallas residential neighborhood, but we need to landscape the streets, brick the street. I mean, there are a lot of things to be done that just people aren't talking about doing. But I can't think of a better metropolitan area, Dallas, Fort Worth, and North Texas to be in than anywhere in the country.
I think you're right. So I know you are kind of right in the middle of what's happening with the convention center, and I'm sure paying attention and hearing about City Hall and the Mavs and the Stars. Give us some thoughts, what you're hearing, what you know, what you think about how that's all going to come down and what that's going to mean for downtown.
Well, first, we'll start with the Stars. Wherever he ends up going, if he leaves AAC, the Stars are going to have to write a $400 to $500 million check. Okay. They end up going to this mall, and this thing people don't talk about. It's like they all think, oh, Frisco will build an arena or Plano will build an arena. Well, you know what? The teams have got to participate. So will he really show up and write a $400 or $500 million check, or take the American Airlines Center for free and the city would remodel it for him for free? Okay. So if I'm negotiating with the Stars, I mean, you got to look at your leverage point. So I'd play hardball with the Stars if I was the mayor. I'd say, here's the arena. Both teams have an option to buy American Airlines Center in 2031 from the city for $1 million. That's it, for $1 million. If I'm the Stars, I'd go back to City Dallas, say, okay, I'm going to stay, but you're going to spend 3 or 4 to the city, not spend it to turn into a hockey-only arena. Okay, that kind of solves that issue, because otherwise he's coming out of pocket $500 million. If you're him, which would you do, right? That's on the Stars. As far as the Mavericks go, if we don't get them on the City Hall spot, now listen, I'm an architectural guy. I love architecture.
Yeah,
I get all of the arguments for keeping the IMP building, but they're saying it's $350 million to update that building. I actually went to the opening of it in 1976 with my parents when that building opened. So I was there day one. They put no money into it since day one. I used to be on the Dallas City Planning Commission and met there every Wednesday. So I know that building, it leaks. It's sinking. There's a lot of problems with it. So the city's got to make a choice. We're going to cut it in half, 150 million to keep it, or move into one of the dead downtown office buildings like Fort Worth has done brilliantly into the Pier 1 building. And people love that building. It's spectacular for the city to have. Tear down Dallas City Hall. Now, this is what you have happening in that end of downtown. Now, at full disclosure, I own the Dallas Morning News site. I own a thing called Founders Square. I own the Greyhound station. I've got some other properties down there as well. So is this self-serving? Maybe, maybe not. So just serve that up here.
I knew that. It's okay.
Yeah. But I just want to break full disclosure. But what's happening downtown right now is a $3.5 billion convention center. They need 3,000 hotel rooms built around it. Those are going to cost at least $600,000 a key. That's almost $2 billion of new hotel rooms. They're going to have to come in, hopefully on one of my sites, with the convention center. Okay. So right there, you've got $5.5 billion. I-30 is getting rebuilt south of downtown, the canyon between downtown and the Cedars with a Clyde Warren Park on top. That's a $1 billion tech stop property project that's just about to start. So that's another $1 billion to lay on there. If the Mavericks build their arena, that's a $2 billion redevelopment Dallas City Hall, which now puts that on the tax rolls, which today City Hall is not. They want to build an entertainment district around there, which will be $500 million to $1 billion. Okay. Now that's just starting. We're at about $6 to $7 billion right there. That's between now, 2025 and 2031. In addition to that, Dallas College, the old El Centro, has got an RFP out, which I'm one of the finalists for, to build them a new downtown Dallas campus. That'll be $1 billion camp. They've already floated the bonds. They've already got the $800 million to $1 billion to do it. Fort Worth is doing that with Texas A&M on the south side of downtown. Massively transforms your downtown. Where does that go? Well, I think it fits best on my Greyhound site, on the parking lots around Bank of America, around the existing El Centro site, and down in the West End. You add that on top. What does that bring? Well, they want to bring, it's the only college in America that doesn't have a Starbucks or a bookstore. So there's nothing associated with it, but now they want to bring in residential. They want to do more graduate programs. When companies look to move to Dallas, they want to educate their workforce. Where do they educate them? That El Centro campus is a horrible facility. And so we need a world-class facility. You throw that, all that added up, what I just said, that's $10 billion of projects that could be built between now and 2031. Everything is approved and going except for the Maverick deal. And the Mavericks will play ball if the city can deliver the site of City Hall. Now, why keep City Hall? Okay, the preservationists, I get it, an architectural thing, but it's a facility past its time. It was built at a time when after Kennedy's assassination, that Dallas had the show. We were truly not the city of hate. We're a progressive city. We're going forward. When it opened was right when Dallas was this takeoff of the TV show Dallas and oil and gas, and real estate and all, but it's just past its time. And the repair of it is just too great. So anyway, that's why I'm optimistic on downtown. If we can get leadership at the city to sit there and go, let's get all these cats I just talked about, sit down at a table and make this happen. And in the Stars case, the Sands has the money, is willing to participate in a major way, like hundreds and hundreds of millions of dollars for their arena. If I'm the owner of the Stars, I'm like, why would you go out there? You already sell out. You already got 100% season ticket sales. It's not like you're going to sell more tickets up north. You don't have to write a $500 million check. I just don't think we have negotiators in the city who understand how, like Trump, how business is done, how business can happen.
Business is done. Hey, Ray, if let's say 70% of what you said happens downtown, $7 billion from, that sort of, central western part of downtown up around to the sort of south central part of downtown, all of that happens there. And we know uptown is just on fire. Is that enough to bring back the stuff in the middle, all the stuff in downtown Dallas that's sort of suffering that old part of downtown? Or will you just have sort of a northern viable portion that is uptown and a southern viable portion, and everything in between will suffer? What's your thought?
Well, one thing is you go, okay, who could possibly be the office users down there? I had to go to a meeting down at the Thompson Hotel, which is the old First National Bank last week.
Mhm.
Once I passed Woodall Rogers, it was probably a good 20-minute stoplight to stoplight to stoplight. Businesses are not going back into the core. They're just not. Okay. If I was king for a day, I would take our Lusteric Justice Center, that huge jail complex we have on the Trinity, which is past its useful life. They need about 1.5 million square feet for a newer facility. I'd take one of the downtown buildings and turn it into the jail and the county courthouse. Take all that mess, clean that up. Now we have an incredible development site overlooking the new Trinity River project we're doing. That takes care of one building. That could take the entire Renaissance Tower off the market and put thousands of jobs into downtown Dallas, lawyers, all those types. Second, I would go to HUD or somewhere. I'd take, if I was mayor, I'd fly right up, meet Secretary HUD, who's from Dallas, Scott Turner, great guy. And I'd sit there and say, what are the tax laws we can do to change to create incentive for people to take the rest of these buildings and turn them into lofts? All right. A piece of sheetrock costs just as much downtown Dallas as it does in Frisco. So what is it? What you and I have talked about this before. It's kind of subsidy or density. The city either has to give you a subsidy for something or they got to give you more density. It's the only way a lot of stuff comes out. Well, in this case, they need to, I would accelerate depreciation in some sense. And I think the federal government should do this instead of a 33-year depreciation on goods and things. I would do a 1 year, just like this right now. If I build a new meat casino, I can write off the cost of rebuilding that restaurant in first year. So there's a big encouragement to spending money on that. If you gave real estate people the incentive to spend hundreds of millions of dollars on improving and turning into loss, but you got to write off your investment in 1 year because you were taking the risk to do all that, I think it'd be a land rush to go downtown and do it.
And we have an affordable housing crisis.
Yeah.
So that's been something our system has been slow to solve for sure. Let's see. Let's go to the economy. Talk about that for a second. So, you've talked about how the economy sends mixed signals, consumer, inflation, interest rates. And you and I've talked about a number of times that as a active restaurateur, sort of mid-priced, and your restaurant peers, how you have a real-time look at the consumer. So how are you interpreting the signs that you're seeing in the economy today?
Sure. Well, I'm on the board of Red Lobster, which is about 700 locations in the United States, total middle class, probably lower middle class customer. I'm chairman of the board of Sunoco, which is the largest. We have more gas stations than anyone in the United States. We have 15,000 gas stations. If you guys know Sunoco, we sell 15 billion gallons of gasoline a year. And so we're large. So I get a lot of consumer data on driving habits, which is everybody.
Mm-hmm.
Red Lobster, how are people doing in the middle of the country? And then I also own Mi Cocina in Dallas, which is a higher end customer on a, higher end casual dining customer. Higher end than a Chili's, but
or upper middle. Yeah.
Upper middle. So the way we kind of see the world right now, it's a K-shaped economy, which means the high end is boom, is off the charts. Okay. And that's like Highland Park Village, we're up about 12% this year. And here, my Mi Cocinas are up. But you look at the other side of the K, where the downward leg is going, and you've got, I'll start with Red Lobster. Fortress bought that out of bankruptcy last year. So it had already gone BK because of that, closed a bunch of stores. Sales are very, very flat. And the middle-class customer just isn't spending money. I mean, they're scared, or they'll go out and they'll get one beer and an entree, but they're not getting an appetizer, 2 beers, a salad, and an entree. They're purely no appetizers and those things. So the consumer spend is down. But if you look at top line numbers, you go, that's interesting because sales for most casual dining is pretty good. Well, the customer counts are down across the industry. And we've all raised prices about 20% since the pandemic.
Yeah.
So if you look at, okay, well, prices are up 20%, sales are flat. Well, what's going on with consumers spending less?
That's not good.
That's not good. Now on the Sunoco side, on gasoline sales, we're the largest seller of diesel in the country, which is trucks, 18-wheelers, and just normal gasoline for cars. 2 years ago, average price in the United States is about $3.80 a gallon. Today, it's $2.84 a gallon. Let's forget California. That's in the fives, but the rest of the country. What does that tell you? Our gas sales are down 2% from the gasoline side, but gas is down 30%. Well, that means the consumer has less money than my waitress at Red Lobster, even though gas is down 30%, has less money to spend to go drive around. Okay, that should be a deal. On the other side, on diesel sales, which we're the largest seller, that is what drives American commerce. We're up about 5% in diesel sales. So what does that tell you? Well, that tells you that we are importing less things because we're moving things within the country more, from a manufacturing plant in Ohio to a warehouse in Nevada. That those primarily on trucks, trains as well, but on trucks. In the past, they come in on ship to Long Beach, be put on a train from Long Beach to Dallas, and then they distribute it locally. But we're getting much more longer haul trucks. So that tells you the economy domestically, the tariff thing really isn't affecting. It's really being shifted quickly. Yeah, as an example, in our restaurants, we took all our plasticware, paper, all that stuff was being made in Vietnam. We're now doing it all domestically at the same price with the tariffs put on it, but it's all brought it back to the United States. So we've shifted a lot of things back here. At Red Lobster, all our shrimp was coming from China. We shifted it all to India, to the Chinese tariffs. And then we started tariffing India. Now we've shifted it all down to Guatemala, Honduras, and, along the coast. We're the largest buyer of shrimp in the world. Well, it keeps getting closer and closer to us, and we've totally boxed out the Chinese. So how do I look at the economy of that? The low-end customer is really tapped. Look at credit cards are at all-time high. The high-end consumer is fine. I mean, they're doing just fine, and they're spending money. This AI thing, who knows where it goes? If everyone thinks it's going to wipe out lawyers and things like that, and maybe basic contracts. But if you're a bankruptcy lawyer or any kind of contract negotiator, I mean, you got to have someone. There's an old saying: you want a young doctor and an old lawyer. The reason you want an old young doctor, he knows the new things going along. You want an old lawyer because they understand case law, negotiating tactics, the way people act, and things like that. A computer doesn't have that kind of thinking thing. So yeah, I don't know. It's going to be interesting where all that plays out.
Yeah. Well, thanks. And what are you paying attention to right now as you look at the economy, different metrics that tell you where we are in the cycle and how to kind of think about investing?
Well, I'll speak on the real estate side. It's so crazy expensive to build anything today. And I'll use an example like a Red Lobster. To build one ground up, we ground lease a piece of land. Used to be, $1.5 million, you could build a building and you do $2.5 million of sales and you can make, a decent profit. Well, today, construction costs, it's about $3.5 million to build that building. It's gone up by a factor of 2. Okay. Sales are pretty much the same, as I was saying earlier. Liquor sales have gone down in that lower casual dining from about 19% to about 11, 12%. Margin is really getting squeezed. So it makes no economic sense to build casual dining restaurants anymore. That's why you see the Chipotles of the world all doing so well. Everyone's moved that direction. And so we build a lot of high-rise apartments. We're building a huge project called the Knox in Dallas right now, which is we bought that project out before the pandemic, fortunately. What that means is we priced everything out before the pandemic. But we're looking at doing some high-rises now, and you just can't price them. They make no sense. So people that are holding projects in this huge refinancing bubble is going to hit 27, 28 for people that have these 3 and 4% mortgages on commercial properties. I don't know if it's better just to work on my handicap and wait a couple of years.
Yeah.
Seriously. And see if the banks start taking stuff back. But if you own a great piece of land for apartments to go up, no one can pencil it out. Our deal downtown, these hotels we want to build, the convention center, the city's got to subsidize. Doesn't make any sense. If you travel around the country, and I travel a lot, I travel every week. If you go to St. Louis, Memphis, or these Birmingham, Alabama, the only construction cranes you see in the air are for public projects, hospital, school, airport, things like that. You don't see a bank building, new headquarters building. You see a lot of AI being built. I mean, it's really hurting the construction business right now, the development business, because they're taking all the materials away for us, which is keeping inflation up. And I was with, I won't name the title company, one of the largest title companies in Texas last week. I had lunch with him. He said they were having the biggest year in their entire history, one of the biggest in Texas. 80% of the business is AI data center related.
Data centers.
They're doing
the cost of those is so high, you don't have to do many of them.
Oh, the one in Abilene, he did a $25 billion project. Their title premium was $41 million, one title premium. But think $25 billion, all the concrete, steel, everything is taken away from us wanting to pave a parking lot. That's the inflationary thing in this economy right now. People think AI is deflationary. In our business, it's inflationary.
Yeah. I want to talk about office. I know you have some experience.
Oh, yeah. I got some now.
Yeah. So, Ray, office space continues to face headwinds. And I know we've discussed that you've done a little office investing, as have we. What are you hearing? What's your outlook on the future? And are you considering any of the big adaptive reuse strategies that others are looking at?
Well, adaptive ones of taking an existing building, doing it, as I was saying earlier, they make no economic sense unless you get some city subsidy. I mean, just none at all. I mean, I looked at an office building in Dallas last week. It's called Three Forks Plaza next to Medical City. 15, 16-story building, 380,000 feet. You could buy it for $30 a foot. $30 a foot.
And, Ray, tell everybody why.
Okay. And there's another building, Walnut Glen's, going for like $65 a foot. Replacement costs, if you told me today, you gave me those plans, go build that building, it's $600 a foot. It's on for 35% replacement cost. Why? Well, one is most of the systems in these buildings are shot. You got to put in new roofs, new elevators, new HVAC systems. A lot of people don't realize is these garages are so old, they can't hold EV cars. An EV car is like 4 times the weight of a normal car. And so these garages are all going to need to be strengthened. And savvy buyers are looking at that going, if this thing goes too much EV, they're going to collapse garages. So you got to put money in to reshore your garages. They've got tenants that have to, the TI is $80 to $100 a foot. Same as if you're in Uptown getting $60, $70 a foot in office rent. You're in the suburbs getting $18 to $20 a foot, still $80. So, I mean, there's no income at all for the TI. So there's no useful life for them. So am I pessimistic about it? Totally. Am I enthralled by it? Absolutely. I mean, bottom fishing guys like me look at that and go, my God, I can buy a building for $9 million with a huge garage. You're like, how does it not work? And tenants today are, from a recruiting standpoint, we're building a building on Knox Street with MSD right now and Trammell Crow Company, $88 a foot. And it was 100% pre-leased. 100% pre-leased, okay? And you look at that and go, my gosh, that's incredible. You can buy a building called Uptown Tower, just sold on Central, not a mile away. Building just sold for like $70 a foot. And they can't get $20. It's like, because the people sign the $88 lease when they're recruiting a kid out of college, they no longer look at it as on the expense side of the equation. It's on the HR side of the equation, the hiring side, the employment side.
Employee satisfaction.
Yeah. So whereas if I've got a building on North Central myself, the only really action we're getting are like small law firms and the big plated people. They're terrified to sign a lease because everyone's afraid AI is going to knock their knees out. So everyone's kind of waiting to see, how does AI affect your business? If you're in the claims processing business and insurance, your business might be just absolutely gone in 2 years.
Yeah. Back to real estate. When you think about just real estate investing, and like you said, you've looked and owned in a lot of sectors. What differentiates the winners and losers? You know, that you mentioned there's winners and losers in different categories earlier. As you look forward, you know, when you're thinking about investing, where are the winners? What's going to differentiate the winners from the losers?
Okay. I'm going to go back. You and I have been in this business for a long time and been through many cycles. When you and I got in the business, we could go find a piece of property, put a deal together, do maybe a 10 pref, 50-50 split. Yeah. And these asset allocators were the big institutions. You might find an insurance company or somebody to go in with you, but it wasn't a big pie of investors. It's primarily, taking the tin can around to a lot of your friends, maybe a couple wealthy guys Well, it's turned into such an institutionalized business now that a CalSTRS or a major pension fund, this is where the market is going. Today, you take them a project, you say, hey, I want you to invest in this deal. And they say, you know what? We own part of the operating business over here. This company over here is that operates shopping centers, or they operate, or we're a partner with big institutional. Or Apollo says, that's great. We already have an apartment business that we own, like Cadillac Fairview bought Lincoln Property Company for apartments. Used to be you could go tap in Ontario teachers. Today, they're like, no, that's okay. We got enough apartments over here. Maybe we'll buy the deal from the deal. So the way I'm viewing the world right now is we have a unique operating platform here. We've renamed our business Gillen Property. And
I like, Ray, that's a classic Dallas story, how you name that business. How many friends of you and I have named their businesses that way? Tell everybody how you named that business.
It's my street. Yeah. It's my street, and it was available.
Princeton, Emerson, Harvard. Think about all the people we know that have done that.
Lakeside, all this stuff. So, but what we are, and I've hired a huge team of people from Heinz. I think we've hired 30 people in the last 60, 90 days. We're going to institutions, and we're being approached, like Kansas City was that way. It was a large lender that had it. They realized to take something as specialized as that, there are only a few groups in the United States that understand luxury, historical properties and the scale, and actually could put enough of their own capital into it where you're just not a pure promoter on the deal. And so much like you've got your expertise in what you're doing, or someone listening to this might have an expertise in industrial, I can't go to Apollo or someone and say, bag me, I'm going to go build a warehouse. They'll go, okay, we own part of Prologis or own part of this or that. But if I go to them, and especially retail, we own a block of downtown Aspen. We have a luxury center in Charlotte. We've got something in Waikiki Beach in Hawaii. There's really no one, there's no retailer that just deal in the, what I call tip of the spear retail. They can go to Hermes and say, we can immediately call them and find out if they're interested in this deal and come in with us. So we're focused on just that. For someone else, so where's the market going? I think if someone is a specialist in, let's say, office, and you can make a credible case for an office building, you got a management leasing platform and development platform, you can make a credible case. It's primarily because the institutions have all kind of manned up with somebody already in every food group except the one I'm in, because the one I'm in is not a very big group for someone to back into. Asana out of Atlanta is very highly qualified, but they're more going into like the deep elements of the world. That they wouldn't be well set for what we're doing.
They bought Victory from us, right?
Yeah, bought Victory. And so they're well set for that. And I think they have an institutional partner to go do those kind of things. If they try to step up to Highland Park Village and deal with the Chanels and Dior's, I don't know where they would go, because most of those high-end tenants are all owned by families. Dior, Chanel, or they're controlled, the LVMH, by family. They want to deal with other families, and they want to know you're just not going to lipstick something and flip it. They're multi-generational whole. So if I was to bring partners in with me in the future, they would just be high net worth families that say, hey, again, it's going to be 10 years being overnight success, but once you get there, it's owning the Highland Park Village or Country Club. It's almost like owning a sports team. They're famous, they're legendary, everybody knows them. And once you've achieved the mass in the cash flow, it's like, if I was to sell it, well, what do I do then? I mean, you can't get a better piece of property.
Yeah. So, Ray, I just got a couple more questions.
Oh, yeah. Ask whatever you want.
Okay. Yeah. So you alluded to AI and tech and a lot of the hype. And beyond that, and if you want to address that as well, it's fine. But beyond that, what other trends or innovations do you see that could reshape development, real estate operations, and even our economy, over the next decade?
Well, look, people are for experiences. Okay. And so if we look at it from the retail perspective, which I kind of talked to or the real estate perspective, I was just in Munich at Oktoberfest, wore my Lederhosen, had the whole deal with my friends. We have a bar in Dallas called the KDHL Ice House. My partners and I from the Ice House went over there. That's kind of where the inspiration came from.
That's great.
Yeah. But what that kind of shows you, I mean, there are thousands and thousands of people. People in today's world, they're not working as much. AI is replacing a lot of work. Even though people are back to office, a lot of people take half a Friday off and things. So everyone is looking for something to go do. And the Highland Park Village is fortunately one of those places. They don't mind going to the monkey bar, strolling around. I'm trying to create like a cruise ship. You kind of come on board. We don't want to leave. And so people that have pride, and that's what a downtown Dallas needs to become. It needs to be the experience is so unique. You want to go there. Well, one thing Fort Worth has done that Dallas has not is the stockyards. That is an incredible. I went by there a Saturday, 2 or 3 Saturdays ago. I was staying at the Drover. Unbelievable Mopsy. And I was in San Antonio at the Pearl District. Unbelievable Swampsy. I mean, just packed.
Yeah.
That's where I think things are going. And the same in your office property. If someone has even an old office building, you got to create I know that you got to have a great weight room. You got to have some fun restaurants. You got to have a bar in there. You got to have a golf simulator. You got to create the experience. People just don't want to go one place and they just get the car and leave now. And I can't speak industrial. The distribution side is getting a lot more of that last mile. That's why industrial is booming so much, is they want to be closer and closer to the population centers. But in the office game, I'll go, I'm not picking on your hometown in Memphis, but I was up there recently. You had that First Horizon Tower downtown. Who would ever build another office building in downtown Memphis? It makes zero economic sense. And there are not even any tenants to do it. So how does a town like Memphis take Beale Street, try to clean it up and get it to where locals and stuff want to go there? But that's kind of where I think things are going. It's going to be kind of decoupling Disneyland from buying a tuition, a ticket, attendance to go into it, a Six Flags. The stockyards, anyone can park on the street and just walk around and enjoy all that. Anyone can walk around the Pearl District. Dallas doesn't have that. That's one thing I hope with our new convention center and the new Mavericks thing, we can create a sense of place that is unique to where we are. Just like Beale Street is, where you are, as dirty as it is, Bourbon Street is in New Orleans. I mean, there are, great environments to go to. That's what we are kind of focused on.
Great. So you alluded to Washington, and you've been in private companies much of your career, other than your time in Washington. Tell me about some of the lessons learned in your public sector experience that have, impacted you, and what you've learned about how Washington works, and give us a little look inside.
Yeah. Well, the swamp exists, and what I learned from being up there, I was a guy, very few people like me that go up, serve, and return home. Most are like lawyers. They might be in private practice, let's say in Dallas, they get a job at DC and they get out, they become a lobbyist and they just work for a firm and it's all there. That's the real distasteful part of the whole thing is people get into this system that a lot of it's hopefully going to get doged out. But I had guys work for me that are in their 30s and they're, 28 years old guy and his wife's say 27. And she is the press secretary for a senator and he's chief of staff somewhere in the White House. And then 4 years later, they reverse roles and she becomes a lobbyist and he becomes, something else in government. They never leave. And I always tell these guys, I go, you'll make great income. Collectively, the two of you, by the time you're 30, will make $1 million a year. Problem is, you live in the suburbs. You have 2 Range Rovers. You got 3 kids, all go to private school. You pay taxes in Virginia. You never get off this treadmill. And every year, you got no money left because it's all gone to tuitions, taxes, those cars, the country club dues and all. To build true wealth, you have to be someone who owns property or owns a business or own hard assets. It's not being the front of a paycheck. And so what I learned up there is people get into this and these lobbying firms pay them so much money. The hook's in the mouth. They just can't leave it because if they end up going back to Nashville or Birmingham or Memphis, they're not making $1 million a year. It's like, that's not the point. The point is to build a long-term asset-based life, not one that's pure paycheck to paycheck.
Yeah. And as you know, my daughter was up there when you were there, and it became obvious just being close enough to it that it's so incestuous. Like you said, you leave and then people and they send you business and you can't ever get out of that incestuous web, it seems like.
Yeah. And they all intermarry each other. That's the other thing. Then no one's has anything involved and so on with the ad agency where you're at. So we do ads for the government, or, so they're all interconnected in some way. And so I learned that up there, and I was happy to get away from that, but I still have a home up there. I'm up there a lot. And I got Potomac fever. Once you get up there, I know so many people up there, but I do zero business with the government, but I'm speaking at a conference tomorrow on Latin American business in the United States. How do family offices for my OPIC days? So I go about once a month and give talks to different groups about that. I enjoy doing that. And then again, the airplane, fly back to Dallas.
Back to reality. Hey, I got a question. I bet you haven't been asked much, but I'm excited to hear your version because I'm thinking about mine. What do you want your last third of your life to be about? How are you thinking about what success will look like going forward? It's not just investor, but leader, citizen, father, etc.
Yeah. Well, unfortunately, my 3 kids are great kids. My oldest son is back running our family office here. My second son is at NYU Business School. My daughter's a senior at SMU, and this is all set up. And we have a pretty robust business here. And we didn't talk much about our oil and gas. We're very deep in the Permian and natural gas. And so our family is really 4 legs of our stool. It's oil and gas business, which is the foundational piece, real estate, this restaurants and hospitality, hotels. We own hotels. And then the last part, just private equity investing. And they all are highly interested in it and want to come back. So I think the next 3 to 5 years is getting that all ingrained here. And then my wife and I, we enjoy traveling. And, it's like, look, I'm 65. I saw a deal in 60 Minutes last week that said, once you hit 75, it's like all downhill. And I looked at my wife, I go, I'm running this best 10 years out hard.
Yeah.
So I'm not hitting it down. So no, it's great because we're a family business, and I'll be back up at DC doing some things. I'm out there doing that a lot specifically. And then look, Dallas, my biggest concern in Dallas is we are totally leaderless ship as far as our mayor is not here. Our council is just so much going on and so many great things here, but we don't have a hard vision of, in the 1960s, we had the first mayor, Eric Johnson, who did DFW Airport. They built all the links. They got the interstate highway system built. I mean, I looked when I was born in 1960 in what was built in the 1960s that we're enjoying today. I just don't see that vision and leadership looking 20 years, 30 years out from now. And then those guys that did all that were in their 60s. They were all planning for their grandchildren, not planning for themselves.
Well, Ray, perhaps there's your calling. You might have just discovered your calling.
Yeah, I live in Highland Park. I'd love to run for mayor of Dallas, but I live in the wrong city.
Well, but maybe you could make even a bigger impact not being mayor.
Yeah.
Hey, Ray, last question is to share with young folks. When you mentor young professionals in real estate, what are you sharing with them, and what are the skills or mindsets that you think are most important for the young leaders of the future?
Well, first of all, it's having a passion for the business. And people would say they want to go in the real estate business, but they're really not passionate about it. And the way you have a passion about it is you articulate something that you enjoy. And a lot of times I'll take people and they say, I want to go in the retail business. So I'll take them, we'll walk around the village, just tell them what you see. If they don't notice obvious things, and it could be, there's like, if I see trash on the ground, I always bend over to pick it up. If I walk by and a kid didn't bend over and pick it up, I go, this isn't your business.
Hey, Ray, my dad, we grew up in the grocery business in Memphis. And I'll never forget, I don't think I've ever walked through a grocery store way back when with my dad that he didn't pick up trash all over the store.
Yeah. And when we first bought the village, my kids were very young. They're 10, 12 years old and 9 years old. And we used to have a Tom Thumb grocery store here, and people leave shopping carts all over the deal. And every night we'd come up here, I'd go home and get the kids and bring them back. We'd push all the shopping carts back. And they're like, I'm so embarrassed. My friends will say, I go, no, you should be proud. They're looking at you going, they care. They actually care enough to take the shopping cart or bend over and pick up the trash. But I would say first, it's a passion about it, but just understand the business you and I got into is not the business they're coming into. It's an institutional business. And if I was young and wanting to be a young Terry Montesi going out there, the avenues you can take at a very young age, I'll call it in your early 20s that you can do is land, because land assemblage, institutions don't buy land typically. And so getting out and understanding, putting together some partnerships to buy land, and then hustling the entitlements and things like that up. That is something you're not competing with Apollo and those guys. Okay. That's first. I think that's a huge opportunity for people. And the other is getting in and doing these little build-a-suits for people like Dutch Brothers and all these little ones that want to do these, because those are not big check sizes and you're not competing with institutional money. You're competing with other young hustlers that are out there trying to put those small, just like a young Terry Montesi doing blockbusters.
Yeah.
At the time you were doing it, that wasn't an institutional deal at all.
Yeah.
But you were able to get an area and build it out. And other guys got other areas of the country and built them out and did extremely well with it. But for a young guy to think, I'm going to buy the Highland Park Village or buy Country Club Plaza or something like that, institutions want experience and they want someone with the chops and not their first time.
Yeah. Well, Ray, this has been a fun conversation with an old friend, and, few people can talk Washington and entrepreneurship, real estate investing, oil and gas like you can. And I really am grateful for you joining us today.
Sure. Thank you for having me, Terry.
Thanks, pal. Ray, this has been a fantastic conversation. Your perspective balancing entrepreneurship, politics, and real estate investing gives a full picture of what leadership in today's world looks like. Thanks for joining us. I look forward to continuing the dialogue.